Welcome back, thinkers and truth seekers. This is James Smith, and you're tuning in to the Real Deal podcast. Today we're peeling back the layers on one of the boldest and most controversial economic moves in recent American history. President Donald Trump's decision to direct $200 billion into buying mortgage bonds. A move he claims will drive mortgage rates down, cut monthly payments, and make owning a home more affordable. But today, we're not here to parrot campaign slogans. We're here to uncover the dark side of this strategy, the unintended consequences, the risks that get buried under sound bites, and the deeper tensions it exposes in the U.S. housing and financial system. Let's get into it. In early January 2026, President Trump took to social media to instruct what he called his representatives to buy $200 billion worth of mortgage-backed securities, MBS. These are bonds created by Fannie Mae and Freddie Mac, two government-sponsored enterprises, or GSEs for short, that stand at the center of America's housing finance system. Trump framed this as a solution to persistently high mortgage rates, a way to make homeownership affordable again. And sure, on the surface, it sounds appealing. But what does this really mean? What's actually happening behind closed doors? And why are experts sounding alarm bells? Here's the short version. The government is funneling trillions of dollars of capital into a specific part of the financial markets. The goal is to push down the yield, and thus the interest rates, on home loans. But the ripple effects are far more complex and potentially perilous. First, let's be clear. The idea that this bond buying solves housing affordability is simplistic at best and deceptive at worst. Economists say this move might shave off only a fraction of a percentage point from mortgage rates, perhaps 0.25% to 0.5% on a 30-year mortgage. That's meaningful for refinancing homeowners, but it does not overhaul the structural housing crisis American families face. Here's the problem. Mortgage rates are just one piece of the puzzle. The real housing crisis is built on shortage, chronic lack of supply, skyrocketing prices, and a market where many Americans are priced out before they even get a foot in the door. Lowering rates a bit doesn't fix that. The result? You may get slightly cheaper credit, but you still have fewer homes to buy. Think of it like this. Imagine your city is flooded because the dam burst. Trump's solution is to hand out bigger buckets. That helps a little, but the dam is still broken. The water is still rising, and the real infrastructure problem remains unaddressed. Now we get into the murkier waters. Trump's announcement relies on cash held by Fannie Mae and Freddie Mac, two government-backed mortgage giants that were put into conservatorship after the 2008 financial crisis. They've accumulated capital over the years that should act as a safety buffer, especially if the housing market sees stress again. Instead of serving as a buffer, hundreds of billions are now being redirected to buy more mortgage bonds. This raises a couple of dark questions. 1. Does this weaken the safety net? These funds were meant to protect taxpayers and stabilize the system. Redirecting them could expose the wider market to risk if rates rise or defaults increase. 2. Who benefits most? Banks and big lenders might see improved refinancing volumes, but ordinary buyers, especially first-time buyers, may barely see the bailout trickle down before higher demand pushes prices back up. And let's not forget, this isn't Federal Reserve quantitative easing, QE. QE was done by an independent central bank, not a president issuing instructions on social media to agency heads. Here's where we enter the realm of governance risk. Traditionally, decisions about large-scale asset purchases belong to central bank policymakers, not the elected executive. When a president starts tweeting directives about market intervention, we cross a dangerous line between political incentives and economic stewardship. That line matters because markets thrive on predictability and institutional independence. When political considerations, especially election-oriented ones, begin to dictate financial policy, you get distorted incentives in markets, politicized risk allocation, and erosion of confidence among investors and institutions. This isn't just theory, it's history. Look back at the 2008 financial crisis. One of the biggest problems back then was that private investors mispriced risk because they assumed the government would always step in. That assumption turned into reality when Fannie and Freddie's portfolios imploded and taxpayers had to rescue them. Now, here we are again, expanding government footprint in mortgage markets, with critics warning that it could redistort pricing mechanisms and broaden moral hazard. And the long-term consequences could be worse than the short-term relief. Let's talk about the housing market's fundamental imbalance. Lower mortgage rates can actually increase home prices. What happens when borrowing money costs less? Demand rises. More buyers can afford to bid. Sellers hold out or raise prices because buyers can shoulder more debt. The net effect? Price inflation. So a policy meant to help affordability can paradoxically hurt it by pushing prices up, especially in hot markets. Meanwhile, the root causes of America's housing crisis remain untouched. Not enough new homes built, zoning restrictions choking supply, construction labor shortages, and investment buying up existing inventory. None of that is solved by a bond-buying binge. Now let's go deeper into the darker implications. First, financial instability. If mortgage bonds are purchased at scale and yields are suppressed artificially, that can create distortions. And when those distortions unwind, the market could see greater volatility. Similar mechanisms in 2008 played a role in destabilizing banks and lenders. Second, taxpayer exposure. Fannie Mae and Freddie Mac are not private entities anymore. They're under government conservatorship, meaning you and every taxpayer bear the tail risk. Using their capital for political goals without clear safeguards puts taxpayers on the hook if markets turn sour. Third, inequality. Big investors, hedge funds, private equity, institutional players are the ones with the expertise and leverage to benefit from these kinds of market shifts. Main Street borrowers? They get fragmented crumbs, if they get anything at all. And yes, there's even backlash from everyday folks who see this as a redistribution of risk to the public, while profits and gains gravitate to the financial elite. This isn't just economics, it's political calculus. Trump's strategy positions him as the champion of housing affordability. On the campaign trail, that's a powerful message. But if economists are right, and the policy fails to move the needle meaningfully, then you're left with a political promise that delivers illusion, not substance. And the political blowback could be fierce, especially if the broader public sees mortgage financing as manipulated for political gain. In short, this strategy may make for great rhetoric, but if it doesn't deliver real change, it becomes a fiasco. Not just a policy misstep, but a political liability. Let's step back. The U.S. housing market is complicated. Mortgage rates are one factor, but they are tertiary to supply shortages, land and zoning constraints, construction labor scarcity, and income-to-price imbalances. Lower rates might offer temporary relief, but they don't fix the structural problems that make owning a home out of reach for so many. Imagine a car with a flat tire. Trump's policy is like adding air to the other 3 tires, a short-term feel-good act that doesn't address the puncture in the one that matters. Without addressing supply, affordability remains a mirage. So where does this leave us? On the surface, a $200 billion mortgage bond purchase sounds like a dramatic move to help everyday Americans. But when we unpack it, the picture looks far less flattering. It's a partial and temporary fix at best. It fails to target structural housing issues. It exposes the financial system to political interference and risk. It may worsen price inflation in the very markets it seeks to help. And it could ultimately shift risk onto ordinary taxpayers. This isn't just economics, it's policy wrapped in political theater. So the next time a headline promises that a bold economic gesture will fix everything, ask yourself, who benefits? Who pays? And what are we ignoring in the process? Because in politics and economics alike, the dark side is usually hiding in the details. Thanks for tuning in to The Real Deal with James Smith. Stay curious, stay informed, and remember, real answers rarely come in 280 characters or tweets.